Welcome to the Solution Nation podcast. My name is Sean Snowday, and I'm the president of Solution Nation. Solution Nation is dedicated to providing a platform for investors to learn about Israel's most dynamic public and private companies. We interview lead venture capitalists, Wall Street analysts, investment bankers, and managers of incubators and accelerators. Our guest today is Anton Fedorov, who is a partner at the Flashpoint Venture Capital, which manages around $500 million through its offices in London, Tel Aviv, Riga, and Warsaw. Now, our topic today is investing in Israeli SaaS companies. And in this episode, we touch on three major topics: assessing SaaS companies, Israeli companies' outsourcing program to Eastern Europe, and venture debt. Learn when SaaS companies should embrace the freemium model versus charging for multiple years of service upfront, when to and when not to charge on a per-seat basis, and the calculation of retention rates. Anton discusses various facets of venture debt, such as maturities, costs, conversion, covenants, and collateral or lack thereof. Again, this podcast includes a discussion of the pros and cons of Israeli SaaS companies programming software in Eastern Europe. We also explore Anton's portfolio's companies such as Comeet and Guesty. Please remember that all content provided on the Solution Nation podcast and website is for educational purposes only. Nothing shall be construed as investment advice. Investment decisions shall not be made based on information, written, verbal, or otherwise, posted or spoken on Solution Nation. Conduct your own research or consult with your own investment advisors before making investment decisions. So here's my good friend, the host of the show, and the CEO of Solution Nation, David Wanatik.
Welcome, everyone, to Solution Nation. I'm David Wanatik. Thank you very much for joining us. Today, we're going to speak with Anton Fedorov, who is a venture capitalist with Flashpoint Venture Capital. Flashpoint's a very interesting venture capital firm. It's an international technology investment firm that manages venture equity, debt, and secondary funds with some $500 million of assets under management. Flashpoint invests in Western software companies with proven business models, supports founders originating from Eastern Europe and Israel doing business in the Western markets. The sweet spot is business-to-business SaaS solutions. However, the company also invests in compelling B2C applications, being sector and business model agnostic. Flashpoint has offices in London, Budapest, Warsaw, Riga, and Tel Aviv. So, Anton Fedorov, thank you very much for joining us today.
Thank you, David, for having me.
So I gave a quick overview of Flashpoint. Would you like to expand on that?
Yeah, I think thank you for the intro. It's been quite precise about what do we do. I think what we kind of strive at Flashpoint is to have a multi-year relationship with the founders. Many times when you're just offering one product, you're basically have like one shot, maybe two shots at a company. And what we believe at Flashpoint is that not necessarily you can make that shot through the right product at a certain time. So by offering basically products from late seed stage to Series C, Series D stage, we can capture about 10 years of founders' development and offer them relevant product as they scale along.
So does Flashpoint often invest in the early rounds, the A rounds, and then if the company is performing well, continue to invest in later rounds?
Yeah, so I'm a partner at the VC firm. We basically focus on late seed and pre-Series A rounds, typically leading or co-leading them. If we miss or for instance, don't agree on something with the founder and the founders take money elsewhere, as they scale along, they might need venture debt. And we have a separate product that offers just that. And there's a separate investment team, separate fund. And, then later on, as the company scales and gets, 10, 20, $30 million of revenue, and the early shareholders, founders, or early employees, or even seed investors or angel investors that are looking for partial liquidity, Flashpoint Secondary Fund basically allows them to capitalize on their investments and take some partial liquidity home. And we sit until the exit event.
Okay. As far as the Israeli companies that you invest in, do oftentimes they outsource some of the programming and software development to some of the other markets that you seek investments, places like Warsaw or Budapest or Riga?
Yeah, I think pretty much every Israeli company of our portfolio has an outsourcing, outstaffing basically function in house. A lot of the Israeli companies actually outstaff or outsource employees to Ukraine, and in light of the current macro, a lot of people are stuck there, and but they still render services and work in these challenging times. Many of them also do have subsidiaries in Poland or Bulgaria or Romania. So Eastern Europe is definitely a region that supports Startup Nation, and we're proud that many of our companies support the local economies there as well.
Okay. How does the talent compare to Israel as far as the ability to program?
I think computer science it's not a new market. It's basically a derivative of logic and math, and Eastern European countries historically has done extremely well in those domains. So I think when Israeli companies are looking to hire exceptional talent, you can historically could have found talent there 30-50% cheaper. I think as there is more money coming into Israel and more companies are getting formed in Israel, this arbitrage is shrinking away. So we're now noticing that sometimes you can only get like 20-25% only discount versus the Israeli salaries, and then you start to question whether it's efficient or not. But I think, but historically, it's been very. All of the companies that we have in the portfolio have at least one or two employees there. The ones that have scaled have usually dozens. So it's proven to be a very effective model to optimize your cost structure for Israeli founders.
So in most cases, do the Israeli companies that outsource to Eastern Europe, do they employ those programmers, or do they hire an outsourced company that employs the programmers?
It's we've seen it both ways. I think with the rise of employment of record or outstaffing companies, they have used those services such as Deal and other companies, Papaya Global, etc. But there's a lot of local R&D houses that are supplying you with hiring and basically managing those employees, even serving to be an employment of record. So, but all of the IP is tied to the buyer or to the ones who's paying for the services. So it's been pretty efficient, even if you don't formally own or employ those employees, they can render services quite effectively.
Okay. How far are some of these markets from Israel by plane? I imagine Moscow may be the furthest. What is that, 4 or 5 hour flight from Tel Aviv?
From Tel Aviv to Warsaw, it's about a 4-hour flight. For some of the continental Europe countries, such as Bulgaria, it's a little bit closer, but they're in the same time zone. I think that's what's more important.
Okay, good. And what about the language and the ability to communicate? Do people in Eastern Europe speak English well enough to converse with Israelis?
I mean, the predominant language in computer science has always been English. So I think if you want to get hired, you should read and write in English. I think many of the times, for instance, for Israeli founders, why they were there's quite a big number of companies that have outsourced R&D to Ukraine is because there's quite a lot of immigrants that came to Israel in the 90s. And so there's usually somebody on the R&D team that speaks either Ukrainian or Russian. So that has definitely helped to bridge the language gap. And but again, like most of the companies, most of the developers, they speak English, and that's the usual communication route.
As the wages are rising in Eastern Europe, are Israeli companies starting to look at other regions of the world to outsource programming, or still focusing mostly on Eastern Europe?
I mean, it's I think Romania has been on the rise over the last, I would say, 3 months when the war kicked off, because hiring employees or scaling employee hiring in Ukraine proved to be challenging. There's quite a lot of relocation of people that needed to be handled to the western part of the country. So people, those companies that were outsourcing, they tried to diversify the pool of talent. Poland has definitely been a step up in this turbulent times. I think there hasn't been we haven't seen many Israeli companies going to India, for instance. Not something that we've seen. I think they're mainly because the time zone you want to operate is the same, and you're quite constrained how far east you can actually go to have an effective team, because management is always in Israel. So so you need somebody within like plus minus 1 hour, and that is basically bound within Central Europe.
Right. Okay. So I know that Flashpoint has a different unit than you are operating in that focuses on venture debt. But maybe you can just take a couple minutes and explain what venture debt is and how it's used to finance companies.
So venture debt is an interesting financial product that is on one end, it's capital that needs to be returned, such as a loan. On the other side, it's the cost of capital of that product is much cheaper than when you raise in equity. So many times business models of companies that, for instance, have either a working capital facility in place, or you need a bridge round to the next round. But you are already raised quite a significant amount of capital, and you don't want to raise maybe more equity dollars to get to the next milestone. Venture debt provides you a pretty good instrument in terms of risk return. Companies that raise venture debt, they're very well capitalized, so there's quite a big equity cushion that sits in the bank that allows for the provider of venture debt to give enough comfort that otherwise may have not been there. I think it's a fairly new instrument in the US. It's been quietly developed. I think every 5th company in the US has a venture debt in place, so that's quite a popular product. In Europe, the penetration is much smaller. There's only a few vendors that actually offer that product. Israel as a market has been more developed, I think, than the other continental European markets, in the fact that the local vendors have been already part of the ecosystem, and Hapolim and Bank Leumi and Discount and Mizrahi. So all of those 4 lenders, they have went, or basically they offer those services and debt products to the companies as well, because they're part of the local ecosystem, and technology has been a big part of the economy. So in Israel, you don't tend to see a lot of venture debt providers, other than maybe at the very late stage, when the financing becomes very cheap, usually a few percentage points, with a few percentage points on warrants. But at the earliest stage, post-Series A, post-Series B, you don't really have a lot of venture debt capital, the banks are usually the ones offering that product because it's much cheaper. Their cost of capital is much cheaper. For venture debt team, you would need to have like a hurdle rate of 6-8%. So when you have a hurdle rate of 6-8% for the fund manager, before he can start offering you, his pricing is likely to be higher than that. So for the Israeli ecosystem, when you have a typical pricing of like 4-6%, it's much wiser to go to the local vendors and seek venture debt from them.
Is venture debt usually intended to be a gap financing instrument, or is it meant to be long-term financing?
I mean, most venture debt products, they have a 3-year maturity. So in the startup world, 3-year, or even in the high growth company, 3 years is quite a long period of time. I think what we've seen is a contraction of cycles where historically you've fundraised around every like 24 months. Now you're starting to see over the last couple of years, as there's more capital, you start to see funding cycles contract to like 12 to 18 months. So by the time the venture debt matures out, you might as well already raised another 2 rounds. So that's why it's attractive. You don't really need to raise equity dollars at much lower valuation. You raise a venture debt, which has a certain maturity. And if you have a solid business model that, you know how to raise money, and you may not necessarily need to raise another, $5 million of equity at a lower price, rather, use that venture debt facility to bridge that gap, raise a round, and maybe even raise another round, and then repay that loan. So from the cost of capital, it's a very efficient instrument.
So the intention and what we hope usually happens is that the venture debt is repaid by another round of capital raising rather than converted into.
No, venture debt, yes. Venture debt is not a convertible instrument. So venture debt is a debt instrument. Many times what happens at later stages, you refinance the loan, maybe through the same provider or through another provider. So you might get to even a liquidity event with a venture debt instrument because it's much cheaper instrument to use. I think what you need to, for founders, they need to understand that it's a debt instrument. So it does have risk associated with the debt instrument. Obviously, because there's a word venture, I think it's more lenient than the bank's loan because it's usually provided by a market participant, and banks are typically not a market participant. But anyhow, like you need to have strong visibility in projecting your results accurately, and once you're there, I think the risks for taking that instrument become much smaller.
Mm-hmm. And are there a lot of covenants associated with venture debt? With other debt instruments, there's covenants as far as what various financial ratios have to be, and cash flow has to be 3 times more than interest payments or something.
Covenants is something that you would have banks associate with. And most of our term sheets, we don't really have covenants. I think it's basically tied into the situation that when we provide venture debt to a company, there is a business plan that we're funding, and it's not like we're over leveraging equity. So the proportion of debt to equity is usually less than 1/3. So you're not really taking a lot of debt relative to how much equity is at stake, and thus we're ensuring ourselves that the company knows how to manage different scenarios. If it goes as they expect, then great. If it doesn't go as they expected, there is a plan how to cut costs, and there is enough cushion for us to be able to return that capital over the next 3 years.
Okay, and I would imagine that issuing venture debt is a good business. I'd imagine that the borrowers are a little less interest rate sensitive because they're looking at this as avoiding dilution. So they might be willing to pay a little more interest to avoid that dilution if they were to raise capital.
I mean, everybody is sensitive when it comes to debt because people understand that it's a product that needs to be returned. I think there's still competition for that product, and different vendors might have, depending on their cost of capital, might offer different incentive. But usually venture debt, it's comprised of several key portions. There is the interest rate, then there is the warrant part, which is basically some equity kicker, which stimulates for taking that early stage risk for companies that have not maybe scaled yet to tens of millions of dollars of revenue, and so that's why it's called venture. So there's a small warrant part, which is it does really provide a lot of dilution, and it's very aligned with company because it's usually takes the PPS of the last round or the average of the previous round and the next round. And so we're incentivized only if the company is able to grow using our money. And then there is some fees that are associated with closing. So depending on the level of competition, you might have one of those components kind of be variable, and it's very case by case, but it depends on some portions. In different times of the market, you might be sensitive on one thing, and when equity prices go down, you might be less sensitive on the warrant part, but maybe more sensitive on the interest rate part. In other situations, you might be less sensitive on the interest part and more sensitive on the equity.
Right. And to what extent do you look at things like patents and trademarks and intellectual property as collateral for these loans, or is that not something you look at?
Well, most of the companies that we have backed through the venture debt product has been SaaS businesses. So even if they do have sometimes patents and strong IP, they would have first and foremost revenue to be able to recoup the loan. I think we only had one life science investment that had limited visibility in terms of revenue, and that company had very strong contracts in place that had certain milestones attached when they are releasing the product to market, and it was very heavily equity backed. So for us, it was very clear that we're not just underwriting the company, but we're also underwriting the investors. And for us, that's also, one of the things is who are the backers of the company. So we'll be able to, assess their credit worthiness, and are they a long-term partner? Are they a short-term partner? Because for us, it's very important that the shareholders of the company are long-term partners. If something goes wrong, we want the equity shareholders to step up and fulfill their obligations to make sure that the company doesn't go bankrupt. It's this particular niche of the market, venture market, has not produced a lot of stress situations. So nobody's we have not seen many cases where venture debt fund manager would take over a company and try to do some fire sale, etc. So we would try to always get a resolute situation with the equity holders, because their equity is at stake. We're usually we're the first principal to go in terms of liquidity event. So they should be mostly concerned about if something goes not according to plan.
Okay, so you don't practice loan to own. Do you ask the equity shareholders to guarantee the loan?
Most often not. I mean, it's we definitely take IP as collateral and all of the intellectual property. So there's an incentive for the equity holder not to default on the loan, because IP in software companies is the only thing that is worth anything other than revenue streams, and there's no personal guarantees from the founders.
Okay. Well, you taught us a lot about venture debt, even though that's not your area of expertise. So really appreciate that. So for your specific investments, I know you do a lot in SaaS and finance and SEO marketing companies. What common themes do you look for? How do you determine one company is a better investment than another similar company?
What we have developed internally quite a rigorous scoring for founders. And we're proud of that. You know, on one end, you know, we try to leave emotions out of our investments, and so what we have found to be the most prudent things when to look is obviously the team. It's not like one and foremost. I think if the team is capable, if the team is strong, is capable to hire, you know, strong leaders that are able to take the company the next milestone. That's number one. We still look at the great big markets. I mean, venture is a field where you can't build a business of $10 million of revenue and be satisfied. You need a market that, you know, is a multi-billion-dollar market. And obviously, we look for companies at our stage that have, you know, strong, you know, product retention. You know, what typical SaaS investors look for is net dollar retention, gross dollar retention. We want to understand that even if the net dollar retention is not, you know, 130, 150%, but only like, you know, 105 and 110, how does the product roadmap is aligned to make sure that they're able to go after larger customers, and how does that product roadmap will enable the company to expand this net dollar retention as it scales? Because usually companies that have an extra 10% in net dollar retention, they typically, you know, are priced, you know, half an X to an X more expensive on the EV sales multiple versus their counterparts. So a company that has 150 net dollar retention, you know, is could be much more expensive than a company that has 100 net dollar retention, 100% net dollar retention. And you can see that, you know, very strong correlation to the public markets, that investors value a lot, you know, whether the company has the ability to rise prices for the existing customers through not just raising prices, but through offering more products and services and able to scale with customer penetration.
Mm-hmm. Maybe you can explain how a company can have a retention rate of more than 100%.
Yeah, so what we're talking about is net dollar retention. So let's say that you have 100 customers that have signed up, let's say during 2021. And so the gross dollar retention is how many of those customers have basically stayed throughout 2020. So by the end of you started the year at 100 customers, and the gross retention, you know, would basically, let's say that 10 customers left. So you're left with 90% gross dollar retention. Then, you know, those 90 customers, some of them, for instance, like half of those customers, you know, decided that they're going to pay not like $10 for your product, or $10,000 for your product, but like $20,000 for your product, because you offered them, you know, some additional modules, or, you know, you expand the number of seats. So basically, those 90% of customers now will yield you like 145% or 135% versus, you know, what they were charging a year ago. So you would basically have a net dollar retention of 135%. So that's what investors are looking for, is that how do you build a product that has a certain set of customers that are expanding very rapidly with your product offering. And, you know, 130 is usually like, you know, a very high number. You know, most products, they are, you know, somewhere in the, you know, 100%, you know, 90 to 110%. You know, if you find a company that has like 130, 140, 50%, that's an outstanding company. And usually there's going to be a price war on the investor side for this business.
Yeah. Do you like the freemium model, or do you prefer that companies start charging right away when they obtain new customers?
I think the the challenge with the freemium model is you really need to have. I mean, we're strong believers in product-led growth, and obviously that's something that has been, in the market and adopted quite significantly from many companies. It's a good model when your end customer is usually doesn't require sales to be involved in terms of the process. So if you're serving, for example, SMBs or lower mid-market companies, freemium model is a great one to differentiate yourself if other companies are not offering that. And so, for example, we have not an Israel company, but a company in the test automation space. They do offer a free trial, test trigger. You can test the software before you actually commit and buy it. And it's a great marketing tool because developers love to test the products and they don't like talking to the salespeople. So for developers niche, it's a very interesting one to offer specifically for them, for instance. But if you're serving mid-market companies and enterprise customers, everybody's concerned with data and everybody's concerned with security. So it's very hard for the mid-market and enterprise customers to lure them in with a freemium model. So you will most likely than not first go through the sales motion and sign them up and negotiate a contract, then do penetration test, security compliance, etc. And only then you would actually give them. You might run a POC in the midst, but freemium model hasn't had a lot of success when it comes to serving enterprise customers.
So for your companies that serve enterprise customers, do many of them try to charge an upfront initiation implementation fee, or one-time charge, or do they go straight into the regular monthly charge?
Yeah, what we have seen is that the smaller the customer is, the tougher it is to convince them to pay annual. So for mid-market companies, it's already quite common. So for example, Comeet, they only charge annual fees. We have a number of other companies like Davidi, that does account receivable software automation. They also only charge annual upfront fees. If you have an offering that starts with 10K ACV, you're able to charge upfront. And for the founders, we highly recommend employing that tactic, because if you're growing 100%, 200%, if you're able to immediately recoup the customer acquisition cost, that means you can immediately reinvest those dollars and basically into sales and marketing. So your working capital cycle, sales and marketing working capital cycle, it becomes much shorter, and you don't have to wait for 9 months to recoup that CAC. And so for many enterprise customers, if you're able to, and enterprise customers, they don't like to actually pay monthly or quarterly, because procurement is a very expensive function. So they'd rather agree on a deal. Sometimes we see companies that are actually paying for 2 years, 3 years upfront, because they want to ensure that this is something that they have kind of paid for, and it will be running for the next 3 years, and you have an obligation to basically maintain that service for 3 years. So that's what we've seen, and I think in this environment, the companies that have maybe overlooked this, how do you charge your customers? Do you charge it on a monthly, or do you charge it on a quarterly or annually? Would definitely highly recommend companies to explore as soon as possible for charging annually, because that will increase your runway by extra 3, 6, 12 months, maybe even, and limit your burn. And I think in this macro environment, cash is king. And so preserve that cash, and the best way to do that is through the lens of your customers, making them to prepay for the software upfront.
Yeah, that's really good insight. That's very valuable information you're providing us with. I'll just make a comment. You can agree or disagree with it, but from the investor's point of view, the investor needs to be careful that they don't overweight those upfront payments. Sometimes if you're not careful, an investor would say, great, the company has generated $1 million of revenue this year, so they're probably going to do $1.2 million of revenue next year. But you want to take a look at how much of that revenue that you're putting a multiple on comes from a one-time fee versus a recurring annuity. Because if you don't, not careful, you may overvalue.
I mean, most of the SaaS companies, there's, for enterprise companies, yes, there may be like a small setup fee. Usually, the license is still like the bigger portion of the contract value. So you might have like $100,000 setup fee because you need to have some custom integration into, I don't know, ERP system of the customer. But most of the dollars in the SaaS world really come from an annual contract that is a software related. And most of the VCs, they don't invest into companies that have a very small portion of the SaaS and a high kind of setup fee. Because what you end up investing in and you get a high multiple for is if you're software-based business. So if like 90% of your revenue is software, then you get a high multiple. You get a multiple of 6, 8. In the previous year, you might have gotten for an acquisition price 10, 12, 15x. I think in this current macro, the multiples have contracted a bit. And we're back to kind of like 2018, 2019, but still for software company, if you're growing and, have a strong rule of 40, attached to your business, you still would expect to get like, 5, 8 times, run rate multiple or higher, because the company is software and it has a high margin. For non-software companies, the multiples are usually very low single digit, it's like 1 to maybe 3x, but not more than that.
And just for our listeners, is the rule of 40, does that mean that the combination of growth rate plus margins should be greater than 40%?
Exactly. I think this is a kind of rule of thumb metric that a lot of the private equity investors and strategics are looking at. How does the company balance its growth rate versus its profitability? I think as the liquidity in the market gets sucked out, with rising interest rates and with investors having an ability to start investing into short-term debt products with high interest rates, you'll start to see like valuations go down, and this prudent approach where your rule of 40 is higher, kind of north of 40, 50, and you get the most out of it. So a company that is growing at like 40% at a pre-liquidity phase is kind of expected to be break even. If you're growing like 80%, yes, you might be losing money because next year, if you're a subscription company, you kind of will catch up. And if you're not overspending, you will basically get, your growth rate might decelerate, but you will catch up on the losses and again, make the company into the break-even mode.
The last question about SaaS companies, do they have good tools to ensure that users are not sharing their seats, not sharing their passwords? People have different computers and different ways of accessing SaaS software. So that's fine, but I guess the companies want to make sure that that they're not getting 2 seats for the price of 1. So they have security mechanisms to monitor that.
I think it will depend very much on the sector that you're serving. I mean, if you're serving, for instance, like a cybersecurity, right? You might not really have a lot of seats attached to the pricing model, and you would just have like in general one license to offer the software, and it's kind of unlimited seats if you want to have more people. So for instance, like Comeet, it has like, generally unlimited seats. So you're actually motivated to onboard as many people as possible into using the software, because the benefit of the product is at 100% when everybody that is involved in the hiring process is using software. And we've seen how like with Comeet, the engagement and participation rate goes from like 0 to 30% coverage of him. Like every talent manager is using the product within like 30 days, basically. And so that's like a good metric. That's what we're striving for. On some other products, on some other companies, you might have a kind of incentivized model for per seat based pricing. But if it's a workflow automation tool, it's very hard to use the same seat and enjoy the benefit of collaboration when the two different people have the same user account and are basically getting like notifications for something they were not supposed to be. So companies are not that obsessed with it, at least not within what we've seen. As things scale, and if you're selling software for a very SMB market, I think this is where things can be tricky. So for companies that typically may have only like one average seat per person, this is where you would probably want to have certain security mechanism and maybe check IPs, or when the pricing is very expensive, for example, for like Thomson Reuters or some such expensive systems where every seat costs like several $1,000s or tens of thousands of dollars or $10,000. If like multiple parties are using that system, then you would be like really incentivized to check that people are not mistreating your software. But I think for most companies, it's not something that we have seen been looked at great scrutiny.
Okay, so let's spend the last couple of minutes talking about some of your portfolio companies, those that have an Israel dimension. So maybe tell us a little bit about Comeet.
Yeah, so Comeet is an Israeli US company. It's an applicant tracking system with a very dominant Israeli market share. We pretty much power probably half of the high growth recruitment in Israel. We also have a strong presence in the US market. And this is a company that has been able to offer and expand the product over time and offer more of the hiring automation and enable more value-added add-ons and services to the companies that is able to expand their net dollar retention kind of north of 110%. I think the guys have done an amazing job in conquering the Israeli market. I think their next journey is to go beyond and scale in the US. That's where the headquarter right now is, and where the co-founders Tomer and Omer sit. And we've supported them in 2019, and the guys have done a phenomenal job scaling the business.
You mentioned Comeet likes to attract as many people as possible at the client companies. So if an applicant is interviewed by 6 people, would those 6 people have an opportunity to weigh in and give their feedback, their impressions of the candidate?
Yes, exactly. And I think the robustness of the platform is that you can tailor for any different job profile that you're hiring a different recruitment process. So for instance, for certain roles, you would want to have, for example, like a panel interview. For certain job roles, you want to have 2 people from a certain hiring managers to be present on the meeting. So you can configure that very accurately, and then everybody has the same. You can set up the questions, you can standardize how the process looks like, and the process is integrated with Zoom of the company, so you can do remote hirings as well. And especially during COVID, as many technology companies have scaled, we were a bit cautious that the company would have during COVID not a strong performance, but the robustness of technology and the fact that you're able to scale hiring during when it's not an in-person meetings allowed the company to thrive actually.
Okay, tell us a little bit about Guesty.
Yeah, so Guesty is it's also an Israeli company that is serving global customers. Most of its revenue actually comes from US and English-speaking countries. and it has also, presence in Europe and in APAC, but over 60% is English-speaking countries. It's a leader in the short-term rental property management space. So what the software does, it enables short-term property managers that are managing distributed hotels on Airbnb and Booking.com and Ctrip and other platforms, HomeAway, to integrate into all of those platforms, OTA platforms, and run a central operating system for your business, from scheduling to cleaning to BI analytics to powering your website. So it's the central piece of IT for those companies, and the company has been very successful into scaling from when we invested in 2016. Since our Series A round in 2016, the guys have raised more than $110 million from blue chip investors, Apex Digital, local investors, Viola Group and Vertex and TLV Ventures and others. So the guys have done a phenomenal job, and it's a company that has an IPO level management, and I think as the company scales, that's what you want the management to grow and the founder team to grow into. And we think that Amiad and Vired, who joined and now serves as the president and chief operating officer, and recently hired the CFO for the company. So it's a company that is able to go to be listed sometime in the future.
Is Guesty a little more focused on the property owner versus the guest, or is it? Yes,
it's a B2B business, so it's kind of a B2B2C. So our customers, their customers is consumers, but our customers is the property managers. So it's a B2B platform for property managers.
Okay, and then the last one, Guru Shots.
Yes, it's an interesting company. It's a leader in photography contest play, and what we found quite interestingly is that people love to take, not just to take photos, but people love to play with their photos. I think people want to have a place where it's not just an Instagram where you kind of upload a photo and you get some likes, and those likes are very proportionate to the amount of followership that you have. But you want to many times compare how well are you doing with your photos versus other people. And what the company has developed is a pretty unique engine that allows to people to participate in different challenges, theme-based usually. So let's say winter photos or animal photos or something like that, or pieces of art or weather, etc. So there's about 400 different themes that are running through the year round on the platform. And once you participate in those challenges, other people vote on your photos. So you get, and everybody gets the same number of basically views. So you get ranked on how good your photo is. And you can be a newbie, but you actually have a master talent, and you can develop that talent and get appreciated by people. And the guys have found an interesting way how to monetize that. Earlier this year, this company that we invested in 2018, it got approached by a Nasdaq public company, and they were offered to buy Guru Shots, and we closed the deal, I think, just short of 3 months ago, and sold the business to a Nasdaq public company.
Oh, great! Congratulations on that. Okay, any final comments that you would like to make?
Well, I think as a VC, you would like to see more founders kind of come up with breakthrough ideas. I think Israel has definitely scaled up over the last few years in terms of how many founders, but I think it's one of the most proactive nations in general when you look at terms of how many entrepreneurs per population that exist. I think with the amount of funding that comes here, I think there could be even more. And the quality of the ideas, I think they're increasing every year. And we hope the founders to come up with even bolder ideas and don't try to sell up, short and try to build a big and global business. I think we've already seen some shift of that over the last 10 years. This kind of company went from a startup nation to a scale-up nation. But I think that's what we hope that Israeli founders will try to see more and more to try to build global businesses.
Great. We like to say Israel is the solution nation. But anyway, I'd like to thank Anton Fedorov for spending so much of his time with us, and he really educated us on many different issues, everything from venture debt to SaaS companies, how they charge their customers. That was a very interesting conversation. To Israeli companies working with coders and programmers in Eastern Europe. Just a couple more words about Anton Fedorov. Of course, he's a partner at Flashpoint VC. He has vast experience in finance, tech, project management, SEO marketing. He's passionate about early stage companies, scalable business models, and superb product teams. So for those of you that have great ideas, feel free to turn to Flashpoint VC and Anton Fedorov. He's on LinkedIn, as well as Flashpoint has their own very nice website that you can find out more information about the VC firm and all their different funds and more about Anton Fedorov. So thank you very much. We'll conclude at this point.